Dickey here. I want to give an update on real estate and where I think things are going. This seems to be a hot topic, so I want to keep updating on this and give you my opinion on what's going on. Now, as I've mentioned before, I'm actually a certified residential appraiser in addition to being a financial advisor, so just getting all that out there so you know where I'm coming from. Now, I'm using Redfin, and not that there's other areas that you get this data from, but it says the same point where the numbers are exactly the same or not. So I'm not all that concerned about the specific numbers. I'm more concerned about trends and where things are going. I know there's a lot of people out there that are scared the entire market's going to crash and all this kind of stuff. And I don't see that. I don't see the same issues that are coming up from what happened in leading up to the 07, 08 debacle. But not that there isn't always concern. Now, give you my starting point. As I've said before, basically the sale prices of homes go down from June, July to December, January, pretty much all the time. And if you look at the time frames, it happens every time. So when you go back to 2022, here's June, the prices go down. From June, they're level, they go down. Same thing is going to probably start happening here. I don't care whether prices go down from June to December. That's very typical because, again, the highest home sales is the May, June, July timeframe. The lowest is November, December, January. And if you want to call it the mid-November to mid-February, whatever you want to say, that it's just that time frame. And people just don't move as much. Part of it is that people don't want to move during school year. They want to move outside of school year. Either way, all you have to do is overlay the numbers, and it's really quite simple. The numbers don't lie. What I want you to focus on are the year-over-year numbers. You're going to hear a lot about these numbers here, where things are coming down and the sale prices are coming down. Don't care. These are the numbers that I'm concerned with, and I want you to be concerned with, because this is the biggest part of CPI that we need to focus on, especially core. Of core, shelter is over 40% of core. It's at 7.3% right now. You're not getting core down to 2 if 40% of your inflationary pie is over 7%. So we need to get real estate down to a number that's reasonable. If it's not around 2 or 3%, you're not getting the whole pie down there. But what we can see here is that this is September, this is the current year, it's the previous year. So the question becomes, where are we at? We're really not all that high. We're at 3.45%, which is significantly lower than what's being reported in CPI and the core CPI, which is 7.3. Now, there's always a lag. So you look at some of these numbers down here, and they're actually down year over year, 3%, 2%. Those are going to catch up in the CPI numbers. And when they do, it's really going to bring the core and CPI down significantly because it's a large part of CPI. Why is that important? It's important because one of the things that's really affecting the real estate market is not having enough enough sellers of existing homes. Now, part of this equation is trying to be fixed by builders. They're building more homes, trying to have more supply for the demand. Now, part of the issue with demand is interest rates. So one of the questions really becomes is when the Fed starts raising or lowering interest rates, is that not going to bring a whole bunch of more buyers to the marketplace? In theory, it should actually bring more sellers because it should loosen up some people who are not as willing to move or willing to sell at this point because interest rates are too high and they're not willing to trade. Now, some of the things I want to focus on as far as why I think there's some issues coming from the real estate side of it, and part of it's just it's gone up so high and there's normal marketplace. So here's one I wanted to show. Demand for vacation homes hits a 7-year high. As an appraiser, one of the things I look at are trends, and typically speaking, when I start seeing vacation homes having trouble selling or not selling for the prices people are asking, that usually tells me that there's going to be a contraction because the first thing people stop doing is buying vacation homes because they can't afford them. They can't get them financed. Or they have to start selling those because they can't afford them because they've either financed them too high or people start not going out there. Now, why this is an issue is very simple. we've talked about the fact that the average student loan is around $500. And there's 43 million people with student loans that currently are using those to go on vacations, to vacation homes, using them to go to movie theaters and all the other stuff. If that $500 is no longer being set aside to be able to do vacations, that means that people are not going to be able to go rent these vacation homes, which means a lot of the people that bought vacation homes, the only way they could afford them is to rent them out. Is if now they can't rent them out, they can't afford the property, so now they're going to have to sell them. So that's going to create a spiral effect in the real estate properties for vacation home sites. Now, again, is it going to be as bad as '08? No, because you didn't have a whole bunch of the loans for people who didn't have jobs, didn't afford it, but it is going to create downward pressure. So it's going to be a thing. So I think this, along with the student loans and interest rates being higher, and these people cannot refinance because, again, they're in a situation where they probably have a lower interest rate to begin with, and now they're just going to be stuck. And the new people that are buying it can't get the rate at 3, 4, or 5%. They're going to have to pay 7, 8, 9%. They're not going to pay as much for a vacation home, that they're going to have to finance at a much higher rate. So they're going to have to push the prices down. Now, is that going to happen? I don't know, but it's what I'm seeing on the horizon. And is it going to happen tomorrow? No, but I'm seeing it happen over the next 12 months, probably 12 to 18 months, that you're going to see this become an issue. And when I start seeing that trend, it rolls into other areas of the market as well. And this is one here that I think we're also missing, in that 1 in 10 home sellers are moving because they're being called back to the office. I think this is a real thing. I do think that productivity is becoming a problem. I think the whole working from home thing has got too far, as most things do. The pendulum swung too far the other way, and we've got too many people working from home, and the companies are going the other direction. And now that we no longer have 12 million jobs for 4 million people, you're going to start seeing the labor market become a little more dicey as well, which again is part of what Powell and the Fed has been trying to do by raising interest rates. So I think it's having an effect. It's taking longer than I think we anticipated, or at least I think the Fed anticipated, but that doesn't mean it's not working. So when I look back on what's going to be happening here in the housing market, I really think that this is going to become a bigger issue over the next 6 months, probably the next 12 months. And I think you're going to start seeing unemployment go up, which is also going to affect these numbers. I also think you're starting to see a lot of new rental homes come on the market, rental properties come on the market, which is, again, it may not be homes, but it's going to be taking people off of the real estate market. So it's going to lower demand because you're lowering the number of people who are in demand or wanting to buy a home. So again, there's two sides of that equation. If you don't have enough homes, you have too many buyers. The only other way to fix it, if you can't increase the homes, is to decrease the number of buyers. And I do think that's what's actually happening here. And I think you're going to see more and more of that as the student loans come up, as the car payments come up, as the job issues come up. People have to go back home to work or go back to work. I think that's really going to be a major effect here. Now, again, is this going to be something where we're going to lose 30% of the values of their homes nationwide? No. Is it something where we're going to see a contraction? Yes. But part of that is just a normal contraction in the real estate market. It is not atypical. It is not something that is a problem. It is something that we have to look at and go, oh heavens, I got to sell today and we're having an issue. Does it mean we have a recession on the horizon? Typically speaking, what I've been saying, and I will be looking at this going forward, is to keep an eye on these numbers. If by the May and June timeframes, we are looking at negative values on the homes, the year-over-year numbers, if we're looking at negative when we get into June next year, and unemployment's at 4.5%, I think we're going into a recession. Now, again, I don't necessarily think that's a bad thing. I think it's probably a good thing to help keep, if nothing else, keep prices flat and not increasing. But that's where I look at this. I do think you're going to see the sale prices go down as usual when we get into November, December, January, and then it will normally flatten out. Sometimes it goes a little deeper, and we'll just have to check. Again, it doesn't matter what the actual values are. Again, they will probably come down, but that's more of a function of the number of sales that are going on. And don't focus on the number of sales, the number of listings, and all this kind of stuff. It doesn't matter. This is what matters. What is the price year over year? Because this is the number The Fed is going to focus on whether or not they raise or lower or keep rates stable. And as far as the stock market is concerned, that's the question. Because if the Fed is just going to keep rates the way that they are and hold them until we get to the inflation we want, all you literally have to do is watch the real estate numbers. And as the real estate numbers continue to go down, and I think they will, and I think they will be negative when we get to June next year, then I think we can start the countdown as to when either the Fed starts reducing or starts talking about reduction. But again, I don't think that's until give or take June of next year, which these numbers are usually a lag. So when I say the June numbers are probably not coming out till July, there might be some numbers we can look at in May. And if the numbers get negative quicker, it could be a bigger issue. But my guess is we're going to continue to have this trend. And this will be interesting because if we're at 3.45 and we've been under 3 pretty much the whole year, at what point does the 7.3% that's listed in the CPI start to reflect what is happening in reality here? And like I say, there is a lag to it, and it is coming down. But this was what gives me the most positive look at how the Fed is looking at this and how I think it's going to look forward. So yes, I think there's going to be some pressure on the real estate market, nothing major. Now, there might be some specific markets that get hit worse. There's some areas of the country that are up and have been up 20% year over year. I think those markets probably have a bigger shot of going down. But I also think there's some areas of the market that haven't gone up hardly at all and probably aren't going to go down much. So I think they're going to give some balance to some of these areas. So you might be in an area that's going to go down a decent chunk. You also might be in an area that doesn't go down at all, which is typically why there's an average. And we go over the United States when we look at these numbers. Again, focus on the year-over-year numbers. It's the only one that really matters because it's the one for the CPI and core, and that's what the Fed's looking at. And as far as the stock market is concerned, that's what's going to run it. And that's what's running the bond yields. That's what's running treasuries. That's what's running interest rates all across the board. So once the Fed decides that they're not raising anymore, or the market decides that the Fed's not raising anymore and is just going to stay where they're at, could mean a really big rally. So keep that in mind. Dickey out.